Step 8. Tax optimization and planning. Taxes are one of the greatest financial obstacles many people face. However, with careful planning, you can strategically minimize your tax liability and maximize your wealth-building opportunities. Tax planning is not only about filing your taxes correctly, but about understanding the different strategies you can employ throughout the year to reduce how much you owe. This chapter will break down the key principles of tax optimization and tax planning. We'll explore how to reduce your taxable income, maximize tax-deferred and tax-free growth, and employ strategies to shield your wealth from excessive taxation. The earlier you start, the more your wealth can grow over time through strategic tax-saving techniques. Understanding the tax system and how it impacts your wealth. The basics of the tax system. To better navigate the complexities of the tax system, it's helpful to dive deeper into the different types of taxes and how they impact your finances. In addition to the three main types already covered, income taxes, capital gains taxes, and payroll taxes, there are other taxes that may apply depending on your circumstances, such as self-employment taxes, estate taxes, and property taxes. Income taxes are the most common type of tax individuals encounter. These taxes are progressive, meaning the more you earn, the higher your rate of taxation. The U.S. uses a system of tax brackets, where different portions of your income are taxed at different rates. For example, the first portion of your income is taxed at a lower rate, and the remaining amount is taxed at higher rates as you move through the brackets. Understanding your tax bracket can help you plan and strategize to minimize your tax liability. Capital gains taxes apply to the profit made from selling investments. The key difference here is the length of time you hold the investment. If you sell an asset like real estate or stocks after holding it for over a year, it qualifies as a long-term capital gain, which is taxed at a lower rate than short-term capital gains. Short-term capital gains are taxed at your ordinary income tax rate. For instance, if you bought a piece of property for $200,000 and sold it for $250,000 after holding it for more than a year, you would only be taxed on the $50,000 gain at the long-term capital gains rate, which tends to be lower than the rate for regular income. However, if you sold that property within a year of purchase, the profit would be taxed at your regular income tax rate, which is higher. Payroll taxes, which fund programs like Social Security and Medicare, are automatically deducted from your paycheck. These taxes are split between the employee and employer, each paying 7.65%, for a total of 15.3%. If you are self-employed, however, you are responsible for the full 15.3% rate, although you can deduct half of that on your tax return, which helps reduce your taxable income. Other taxes like self-employment taxes apply if you are a freelancer or small business owner, and this tax helps cover Social Security and Medicare contributions. Self-employment tax is calculated based on your net earnings from self-employment and is in addition to income taxes. Finally, estate and property taxes are another consideration for wealth management. Estate taxes apply to the transfer of wealth after death, with thresholds and exemptions that vary depending on the value of your estate. Property taxes, on the other hand, are assessed on the value of your home or other real estate you own, and these taxes are typically paid annually to local governments. By gaining a clearer understanding of the various types of taxes and how they function, you can better plan for them in your financial strategy. Whether you're managing your salary, investments, or business income, recognizing your tax liabilities allows you to create opportunities for tax savings, better budgeting, and ultimately, a more effective path toward financial growth and security. How taxes impact your wealth. Taxes can have a significant impact on your wealth accumulation over time, especially as your income grows. The progressive nature of the tax system means that the more you earn, the higher the percentage of your income is taxed. While taxes are inevitable, there are numerous strategies available that can help you minimize your tax liability, ensuring that more of your income stays in your pocket and can be used for investments or savings that contribute to your wealth-building efforts. Strategies for reducing taxable income, tax-advantaged accounts, deductions, etc. Tax-advantaged accounts, how to save more by reducing taxes. Tax-advantaged accounts are a powerful tool in managing your financial situation, as they provide significant benefits that help reduce your tax burden while also fostering savings and investment growth. These accounts allow you to either defer taxes until a later date or avoid them altogether, which can significantly enhance the growth of your assets over time. The 401k and 403b retirement accounts are among the most common tax-advantaged options offered by employers. These accounts allow you to contribute pre-tax dollars, meaning the amount you contribute reduces your taxable income for that year. For example, if you earn $50,000 annually and contribute $5,000 to your 401k, your taxable income will be reduced to $45,000. This means you pay less in taxes right now, and your contributions can grow tax-deferred within the account. You won't owe taxes on the money until you begin withdrawing it during retirement, allowing your funds to compound and grow without the immediate drag of taxes on the gains. Roth IRAs, on the other hand, provide an alternative approach. While you do not receive an immediate tax break for contributing to a Roth IRA, meaning your contributions do not lower your taxable income for the year, the benefit comes later. Your investment gains grow tax-free, and the best part is that when you withdraw funds in retirement, they are completely tax-free, as long as you meet certain conditions. This is particularly beneficial if you anticipate being in a higher tax bracket when you retire, as you can essentially lock in the tax-free growth during your working years. For instance, if you contribute $6,000 to a Roth IRA, you won't lower your current taxable income, but any gains you make in the future are not subject to tax when you withdraw them. If your investments grow significantly, the tax-free nature of the account becomes a powerful tool for maximizing your retirement savings. Traditional IRAs are similar to 401k accounts in that they offer tax-deferred growth. However, they come with their own set of rules, such as income limits and restrictions on how much you can contribute each year. The contributions to a traditional IRA also reduce your taxable income for the year, which provides immediate tax savings. But, just like with a 401k, the taxes are deferred until you begin withdrawing the money, which typically happens after you reach retirement age. Health savings accounts, HSAs, are another valuable tax-advantaged account, particularly for those with high-deductible health plans, HDHPs. HSAs offer a triple tax advantage. Contributions are made with pre-tax dollars, they grow tax-free, and withdrawals for qualified medical expenses are also tax-free. This makes HSAs one of the most beneficial savings tools available, especially as medical costs can be a significant source of financial strain. Not only do contributions to an HSA reduce your taxable income, but the funds grow over time without being subject to tax, and when you use the funds for eligible medical expenses, there are no taxes on the withdrawals. The beauty of these tax-advantaged accounts lies in the compound growth of your money. Since you're able to contribute pre-tax dollars or receive tax-free growth, the money inside these accounts grows faster than it would in a standard investment account, where the gains are subject to annual taxation. Over time, the tax savings allow you to build a larger nest egg, giving you more financial freedom in the future. Ultimately, by using tax-advantaged accounts strategically, you not only reduce your current tax burden but also maximize the growth of your investments. This allows you to build wealth in a way that is more efficient and effective than relying solely on taxable accounts. Whether it's through retirement accounts, Roth IRAs, or HSAs, each of these tools plays a critical role in ensuring that your hard-earned money works as hard as possible to secure your financial future. Tax deductions and credits, lowering your taxable income. Deductions, reducing your taxable income. Deductions are one of the most powerful tools available to reduce your taxable income, which can, in turn, lower your overall tax bill. By lowering the amount of income that is subject to tax, deductions reduce the tax burden you face, allowing you to keep more of your earnings. There are two primary types of deductions you can take advantage of: the standard deduction and itemized deductions. The standard deduction is the simpler of the two and is automatically available to most taxpayers. It's a flat amount set by the IRS that you can subtract from your taxable income, and it varies depending on your filing status: single, married, filing jointly, head of household, etc. This amount is updated annually to account for inflation, helping taxpayers keep pace with rising living costs. The standard deduction is available to anyone who doesn't have enough deductible expenses to exceed this threshold, making it the default option for many. On the other hand, itemized deductions allow you to subtract a specific list of qualifying expenses from your taxable income. These expenses may include mortgage interest, state and local taxes, charitable donations, medical expenses that exceed a certain percentage of your income, and some other out-of-pocket expenses. Itemizing is typically beneficial for individuals whose total deductible expenses exceed the standard deduction amount. For example, let's say the standard deduction for a single filer is $12,000, but after tallying up your deductible expenses, such as $6,000 in mortgage interest, $3,000 in state and local taxes, and $6,000 in charitable contributions, you discover that your total deductible expenses amount to $15,000. In this case, itemizing your deductions would allow you to reduce your taxable income by $15,000, providing a greater tax benefit than simply taking the standard deduction of $12,000. Itemizing requires more documentation and record keeping, so it's crucial to track all eligible expenses and retain receipts and statements. However, if your deductible expenses surpass the standard deduction, this method can provide substantial savings on your taxes. By understanding when to apply the standard deduction versus when it's more beneficial to itemize, you can make smarter financial decisions and potentially save a significant amount in taxes. Tax credits, direct reduction of taxes owed. Tax credits are one of the most effective ways to reduce your tax bill, as they directly lower the amount of taxes owed. Unlike deductions, which only reduce your taxable income and, by extension, the tax rate applied to your income, tax credits provide an immediate reduction in the amount of tax you need to pay. For example, the child tax credit, which provides up to $2,000 per qualifying child under the age of 17, directly decreases your tax liability. If your tax liability is $3,000 and you qualify for this credit, your bill would be reduced to $1,000, which provides immediate relief. There are also other tax credits designed to assist with education costs. The American Opportunity Credit, for example, helps offset the expenses of undergraduate tuition and fees, providing up to $2,500 per eligible student, with up to $1,000 of that amount being refundable, meaning it could result in a refund even if you don't owe taxes. Similarly, the Lifetime Learning Credit offers up to $2,000 per tax return for tuition and fees paid for post-secondary education, making it a valuable credit for those taking courses to advance their education or career. Tax credits are available for various expenses and life circumstances, and they provide significant opportunities to reduce your overall tax burden. Because these credits are subtracted directly from your tax owed, they are often considered more valuable than deductions. By strategically leveraging tax credits, such as those related to children, education, or energy-efficient home improvements, you can not only reduce the amount of taxes you owe but also potentially increase your tax refund, putting more money back into your pocket. This is especially important for wealth-building efforts, as the money saved from tax credits can be reinvested into your financial goals, whether that's saving for retirement, paying off debt, or growing your investments. How to take advantage of tax-deferred and tax-free accounts. Leveraging tax-deferred and tax-free accounts for long-term wealth. Tax-deferred and tax-free accounts are essential tools for long-term wealth building, as they provide opportunities to grow your investments without the immediate impact of taxes. By utilizing these accounts effectively, you can create a foundation for financial growth that compounds over time. Tax-deferred accounts, such as 401(k), and traditional IRAs, allow you to defer taxes on contributions and investment gains until you begin making withdrawals in retirement. This means you don't pay taxes on the money you contribute or the growth your investments experience in the account. The advantage here is the ability to invest more of your income upfront, with the potential for your investments to grow faster due to the compounding effect. In retirement, when you begin to withdraw from these accounts, you will pay taxes at the ordinary income tax rates applicable to your withdrawal amount. However, the key advantage of tax-deferred growth is that it allows you to postpone tax payments until later, potentially when your income and tax rate may be lower. Tax-free accounts, such as Roth IRAs and health savings accounts, HSAs, take a slightly different approach. Contributions are made after tax, meaning you don't get a tax break when you contribute. However, the major benefit comes when you make withdrawals. Both the contributions and any earnings are tax-free as long as you meet specific requirements. This can be especially advantageous if you anticipate being in a higher tax bracket when you retire. The tax-free growth means that all the earnings on your investments are not subject to taxes, which is a significant benefit over the long term. For example, imagine a 30-year-old who contributes $6,000 annually to a Roth IRA. With an average annual return of 7%, by the time they reach 60, their account balance could exceed $500,000. Since the Roth IRA offers tax-free withdrawals in retirement, they would be able to access the full $500,000 without paying taxes on the growth, which makes this a powerful tool for retirement savings. This is particularly helpful if you expect to be in a higher tax bracket when you retire, as you avoid paying taxes on those future earnings. By taking full advantage of tax-deferred and tax-free accounts, you can significantly enhance your wealth-building potential. These accounts not only allow you to grow your investments more efficiently, but they also provide powerful incentives to invest for the long term. Whether you're saving for retirement, a major purchase, or building a legacy, using these accounts strategically will allow your wealth to accumulate more rapidly and with fewer tax-related obstacles. Hiring a tax professional versus DIY tax filing. Should you hire a tax professional? As your financial situation grows more intricate, the benefits of hiring a tax professional become even more pronounced. Many people underestimate the complexities of taxes when it comes to various income streams, investments, and deductions. A tax professional can help ensure that you're leveraging the full spectrum of available tax-saving strategies, minimizing your tax liability, and ensuring compliance with current tax laws. They can help you navigate tricky areas like depreciation for rental properties, tax credits for education or home improvement, or optimizing your tax situation through strategies like tax loss harvesting. Moreover, tax laws are constantly changing, and keeping up with those updates can be challenging. A tax professional is equipped with the knowledge and experience to stay current on these changes, ensuring that you're not missing out on any new opportunities or inadvertently violating tax rules. They can also advise you on how changes in your financial life, such as a new job, marriage, or a growing business, may affect your tax planning. Additionally, for those with complicated tax situations, such as running a business, managing multiple investments, or dealing with international income, a tax professional can help organize and prepare your filings correctly, preventing costly mistakes. They can also provide advice on the best structure for your business to minimize taxes, help with strategic tax planning for future years, and guide you in keeping up with filing deadlines to avoid late fees or penalties. For example, consider someone who is self-employed and claims business expenses. A tax professional would help ensure that expenses are categorized properly to maximize deductions, as well as ensure compliance with all tax codes related to business income and expenses. Without professional guidance, you may miss out on deductions or credits available to you. A tax professional's support can also bring peace of mind, knowing that your taxes are being handled correctly and strategically, allowing you to focus on building your business or managing your personal finances. Planning for future taxes and the impact on your wealth-building strategies. Long-term tax planning, anticipating future taxes. Long-term tax planning involves anticipating how taxes will affect your financial goals in the future and taking proactive steps to minimize the impact. This requires a strategic approach to investments, retirement savings, and asset management. One key aspect of long-term tax planning is considering the tax implications of actions you take today, which could affect your tax situation down the road. For instance, if you're planning to sell an investment property, such as real estate, and it has appreciated significantly in value, you could face substantial capital gains taxes on the profit. These taxes are calculated based on the difference between the sale price and your original purchase price. However, by planning ahead, you can minimize this tax liability. One effective strategy is the use of tax-advantaged accounts, which allow your investments to grow tax-deferred or tax-free, reducing the tax burden when you eventually sell. Additionally, techniques like tax loss harvesting, where you offset gains by selling other investments at a loss, can help you reduce your taxable income. Another common strategy for real estate investors is a 1031 exchange. This allows you to defer capital gains taxes when you sell one property and reinvest the proceeds into another like-kind property. This strategy can be extremely beneficial, as it postpones the taxes you would owe and allows you to continue growing your investments without the immediate tax hit. By deferring these taxes, you can reinvest the full proceeds, accelerating your wealth-building efforts. The idea behind long-term tax planning is not just about avoiding taxes in the short term but creating a roadmap for the future, where taxes are considered at every stage of your financial journey. By integrating tax-efficient strategies into your overall wealth-building plan, you can keep more of your gains and ensure that you're always prepared for the tax consequences of your financial decisions. Whether you're planning for retirement, real estate investments, or business growth, anticipating future taxes and taking proactive steps today can help preserve and grow your wealth. The bottom line: effective tax planning is one of the most important elements of wealth creation. By understanding how taxes work and using tax-deferred and tax-free accounts, taking advantage of deductions and credits, and planning ahead for future taxes, you can significantly reduce your tax liability and keep more of your money working for you. Whether you handle your taxes yourself or hire a professional, proactive tax planning will help ensure that your financial future is as tax efficient as possible.